Hello, this is Right Side Trader. Today is June 22nd, 2025, and this is going to be a quick little presentation on options, a little bit about the pricing and an example. This is all for educational purposes only, no trade recommendation, because as we all know, trading is risky. You can lose money at trading, so please check with your financial advisor, please check with your significant other, and make sure trading is something that is suitable for you. I'm going to be looking at really, I had ran into a couple of people this week, and when I was talking to them, I realized they didn't understand what I was talking about when I was talking about options and all. And so again, I told them it's one of the things that I do and one of the things I like doing, and all, cause they once you have and I told them don't trade them if you don't understand them, you don't know what I'm talking about. Get educated. Number one, get educated. And that's why I say I'll put something. On the next few weeks. I'll be putting out a video on, on the calls, on the puts, and all buying and selling them. Something basic stuff. Also, if you're really interested in this, on your platform you should have education. If you don't want to come to us and learn more about charting, we talk more about charting and strategies and how to actually really make money in the market and using the indicators and all that type of stuff. But these other guys, they talk a lot about option strategies. Option strategies, I'll have them in the links in my description and all that kind of stuff. You can check those guys out too. They're really good. I hope they don't mind me. And I don't get anything from them. I just they're good. That's all. If you review their stuff, and kind of take a look. I'll give you some groundwork to help you get going. I hope I don't confuse you too much. What I'm gonna do is just go over the next few weeks. Like I said, I'm gonna go over puts and calls, buying and selling, and really basic stuff that I think is basic, that if you watch this a few times, you'll get it. And it's not getting too technical and too much into all the terminology and all that kind of stuff. Just basic stuff, I think, to me, now. And I'm going to be using some of the stuff that it's going to be basic. Let me just say it's going to be basic stuff. Let me get started. And I'm going to be looking at Bank of America, what you see there on the screen, and then an example with that, and of what's going on. No trade recommendation at all. This is not for this particular strategy that I'm going to be talking about, and all. It's definitely not the time to be doing this. So that's another reason why I did it, and I'm saying it up front. Do not, and I will show you on the chart when it's the ideal time to do it, and how I look at things. But let's get started. And this like I call it option 101. The money options, that's the whole thing, and that's when it comes to put selling. It's a great strategy if you apply it correctly, and all. So let's go ahead and get started here. Yes, first of all, when it comes to options, you need to understand that they are it's a contract, and all. And when you have a contract, you have and with these options in this financial market, there's always two parties. There's a buyer and a seller, and you can be a buyer or a seller. A lot of times they don't explain that to you or tell you that, But a lot of these a lot of the new education stuff that's out there, they kind of go over both sides. Some of them are more leaning towards one side than the other, which is not a bad thing because they explain it pretty well about all the risks that's involved in playing both sides, which is what you need to. And I'm not getting into all that. I'm just kind of letting you know what's available and showing you an example of what can be done with one of the sides and all. Yeah, and again, when it comes to contracts, all contracts have expirations. So when it comes with options, there is an expiration date, which sometimes I think people don't realize. I've seen traders who've been trading for a while don't realize your option has an expiration. You got it if you're buying or selling an option. Definitely when you're buying an option, you need to give yourself time to be right. When you're selling an option, you have a couple of things, and that's the only thing. You have time. You got to give yourself time to be right because it has to move in another direction in order for you to move money. If it doesn't move in the right direction, you're going to be losing money based on it's not moving in the right direction. And since this contract has a time value, you're going to be losing money because time is passing by based on where you buy your options at and all. So they have an end date, there's a time, and there's an expiration and all. So now the other thing about these contracts is these contracts represent 100 shares of a product. I say of a product because it can be an ETF, it can be a stock, it can be, I think even the future contracts are 100 shares. I'm not sure. I haven't traded future contracts yet, and I haven't really watched that much stuff on future contracts yet. Something I do want to try to take a look at, but every time I look at them, based on the way I was educated about options and stuff, and me want to look at be able to be on both sides, buying and selling. It's a lot of things about when I look at the stuff that I'm trading, the future contracts, contracts that I am trading with, didn't try to trade option contracts on that. It's not. I don't see too much there for myself, and also I haven't really jumped into on that side. But when you're trading any kind of stock, any kind of ETF and all out there, if they have options, that option represents 100 shares of that product and all. So that means, number one, when you're looking at any pricing out there on those pricing, it's all going to be times 100 and all. Now, the other thing about the contract and all, they have values, and these values are based on the strikes. And when we're going to take a look at the option at the platform, and I'm going to point out all the strikes and stuff and all to you. But then you'll hear people talking about at the money strikes, out of the money strikes, and you can have calls out of the money, you can have puts out of the money. Then they talk about in the money strikes, and all. Then you can have calls in the money, you can have puts in the money. It's all based on where is at the money is at, where the underlying product is trading at, and then based on that, if it's a call to be out of the money, it's going to be above price. If it's a put and it's out of the money, it's going to be below price. Options, this is where it starts getting kind of confusing, even for me. Even I've been trading this for a while. Okay, what's in the money, what's out of the money, and all that kind of stuff. But once you look at the platforms also try to give you, they shade the different areas to let you know that you're in the money or out of the money, and we're going to take a look at that. And it'll be a lot clearer than maybe a call in the money. That means price is actually above, so you got value. They talk about these. You got value actually in that contract, in that option. On a put, for it to be in the money, meaning I always get confused on puts. Puts, I usually want to sell below market to be out of the money. I want to sell above market to be in the money. And also, because again, a put, when I'm selling a put, it's a bullish thing. So I expect the stock to go up in order for me to make money. And if I'm going to be selling something above the market, that's going to be in the money. So I need to go up for me to make money and then become out of the money where I can actually keep that money and even more money. It's the way I always kind of think about it and all. And then the other thing when it comes to this contract and all, it's the whole expiration. When it comes to expiration, on option contracts, different products have different expirations. A lot of the indexes these days have daily expiration, and some of the highly traded stocks might have daily expiration. I don't know. I don't trade too many stocks that have. I haven't traded any stocks. They may not have daily expiration on the stocks, but I know a lot of some of the ETFs. The indexes, they have daily expirations. Now, the Qs and the SPY where I trade, they have daily expiration. They also have the weeklies, the monthlies, the quarterlies, and leap expiration. We're going to take a look at the platform, and I'm going to show you exactly what I'm talking about there. And then the other thing that you got to realize is when people are talking about expiration, this is that date when that contract will cease to trade. At that point, if you are actually still holding it, you shouldn't be, unless it's way out of the money and you don't think some crazy event is going to happen to cause it where it's going to be in the money or actually go where this particular contract would go against you and cause you have your winning trade to turn into a losing trade, whatever it may be. That's why usually in most cases when it comes to expiration, most of us are not looking at holding things. I laugh because these days with 0-day options, a lot of us are trading these options that if you don't get out of it, they're going to expire on you anyway. But very seldom, even then, do you hold these things to expiration, because anything can happen, even at the close of market, and cause you what was you thought was a winning trade and you could walk away from. It can end up being the mother of all losses, in this market. Because you gotta always remember that anything can happen at any time, and have that type of mindset where you know where you want to get out of your trade at, take your profit, take your loss when you need to do it. Because again, at expiration, your options can end up with no value, and that can be a good thing, a bad thing, but based on if you bought it or sold it. The other thing, there are cash settle options that are out there, and that cash settle option, it can have cash where it's going to be remaining into your account, or that cash value can actually get where it's going to be taking money out of your account. So you got to be aware of that, whatever you're actually trading, how does it settle, and all. And the other thing you need to also be aware of, just made me think about, some options, they have these European style options and these American style options where they can be exercised at any time. I usually stay away from these crazy things that can be exercised at any time, when it comes to my trading. So I usually stick with, I'm mainly, again, I'm trading stocks that I don't mind owning, number one, and I do own. And I'm trading stuff that are cash settled that's really not going to early exercise on me, because that's the other thing that can happen when you are buying or selling these contracts and all. At expiration, based on if you bought or sold or whatever, if you sold something, that means you were shorting. In most cases, if it was a call, you were shorting that stock. It's another way of shorting stock. And if at expiration, that thing is in the money, they will, number one, most of us retail traders, we have to own the stock first of all in order to sell that call option, to be shorting that stock. And I'll say that we're willing to sell stock. If you got the large enough count or you're trading a product where they know they kind of give you a little leniency to actually sell that option, because they know there's a high probability of that particular product to be going back down maybe in the near future, and your account can handle whatever may happen. They allow you to sell that call naked. And if in the case the price end up being above the strike that you actually sold, and you end up short that stock or whatever, or I don't know, it may be cash settle, or you may end up short that stock. And then in order to get profitable on that, you need price to come back below the strike that you actually sold. Now, on the other side, with long, where you can end up long stock, it's kind of like when you're selling a put. Because ideally, when you sell a put, it's saying that you are willing to buy stock. And in all cases, when you're doing that, your expectation is the stock to stay above the strike that you actually sold. And that's the example that I'm actually showing today. But if that stock or that stock price or that ETF price ends up dropping below the strike that you sold, you have said that you're willing to buy that stock or that ETF at that strike price, and then you become an owner of 100 shares of that particular product. So I said a lot there, just looking at this now. And the thing is, you ended up in both cases of these short stock or long stock, you received some type of credit. So you received some money when you sold that contract, and you was willing to take the risks to actually be short stock or long stock. And that comes down here to, there's always a buyer and seller, and you got to remember, anytime you're buying and selling any of these things, the prices that you see on the platform is always times 100. So remember that. And the value at the strike price that you're actually selling stuff, that's also meaning that at that strike, you're willing to buy or sell 100 shares of that particular product. There's a lot there on that. All right, but let's go ahead and go to the next slide here, and let's try to put this. I kind of put it all together, but I'm gonna kind of spell it on out here. And I'm gonna just do one example here. As you can see, this can get kind of long-winded if I was trying to do on all four things that you can do. You can buy a put, you can sell a put, you can sell a call, you can buy a call. Here, I'm only going to cover selling a put on this presentation. So selling a put, the ideal thing you want to put C high. You should be selling high, and you want to buy low. And this is again where it gets kind of confusing. You know, when you hear somebody say that, well, what you mean sell high? Again, ideally, you don't want to sell a put when the stock is high. You want to sell a put when the stock is low. I'm going to show you this on the chart. And then you want to, at that time, the option prices, you hope they're a little bit inflated. I won't get all into that. And you can sell a put and collect some premium for that. And your expectation is that the stock will go back up. And as that stock price goes back up, your put price will actually goes down. So you'll be able to actually sell a product at a high price, and you want to buy it back at a lower price. Now let's look at this a little bit closer. The cash that you need in your account, you need cash in your account or margin in your account to secure the sale. Number one. So that's why, again, this strategy is not for everyone. Because, again, sometimes it takes quite a bit of money to have in your account in order to actually execute one of these trades. And in this example, I'm going to go through that. This is a bullish trade. You need the product, the underlying, or the product, or the stock, or the ETF, or whatever, to move up in price, and you need time to pass in order for you to make money. And now in this example here, I'm going to give you spell out an example. One contract of Bank of America, BA sale, Bank of America, I sell to open a 17 June 2027 45 put. I'm able to sell that for $5.65. In order to do that, I need $4,500 if I'm in a cash account. And in a margin account, I'm not exactly sure how much you would need in order to do that. Since this is like a couple, as you can see, it's a couple of years out is what I did. I did the example on. Because this is not a trade recommendation. So don't try doing this, and don't go doing this at all. I wanted to do something out there crazy. It's not, and it's the wrong time to actually be doing it. So again, I go off like this because I don't want people to try to execute this trade at this time. It's not the time to be doing this trade. And I'll show you the chart and show you why I'm saying, or what I'm looking at to say this is not the time to be executing this trade. In my opinion. So again, back here you need $4,500 in cash or margin to execute this trade. As soon as you execute this trade, though, you're going to get $565 minus commission deposited into your account. You can close this trade at any time. That's the other thing that sometimes is not clear when you're watching videos and watching people talk about options and all, is that you can open that trade and then you can close it 2 seconds later if you really want to. And the difference between there, if you make money or lose money, that's what it would be. But in order to make profit on these type of trades right here, when you're selling a put, like I said from the beginning, you want to sell high, not see high, and you want to buy it back lower. So again, say we sold that at that 565. So now we're going to turn around and we're going to want to buy to close that one contract, 17 June 27 45 put for anything less than $5.65. So if we close at a dime less than $5.65 for $5.55, we would make $10. But my example, I'm going to say we sold to open for $5.65. We buy to close, that's that BTC, for $4.65. Our profit is $5.65 minus $4.65, which equals $1 or equals $100, because everything is multiplied by 100. So your profit will be $100 minus any commissions. Now, the other thing, okay, so that's okay if you make money. What if you lose money? If at expiration or any time, this contract is worth more than $5.65, that means the market went down, that option price is going to be higher. So say you close at $1 higher, that means you would have to close this contract for $6.65. I didn't put it on the slide because we're not losing on this trade. We're going to make money if we was doing this trade. This is not the right time to be doing this trade. Not a trade recommendation. I have to say that again. You would lose $100 on this trade because, again, you would have to come out of your account, not just that $565. You got to come out of your account for an extra $100. So that's $665. So you end up losing $100 on that trade. You didn't lose that $4,500. That was just to secure the sell and all. So that was just to make sure that you had the money in your account. Worst case, say you didn't close this trade at all, and this market closed below $4. Closed below $45. Say it closed at $44.90 and all, 10 cents below $45. Your broker will spend $4,500 and buy 100 shares of that stock and have it in your account. So that's the way it kind of works when it comes to the put sale and all. If the stock ends up dropping, you're going to pay $45 per share at 100 shares, $4,500. No matter, even if it goes down to zero, you're going to get that. Or if you can close, probably wouldn't be able to close the contract for less than that. But that's what happens. If you close at any time at any price above $5.65, you need to take the difference between that price and that $5.65, and whatever that difference is, that you can look at that additional money coming out of your account is what you got to look at. So that's pretty much it on that. Let's take a quick look at the charts right quick, and I'll show you ideal times to actually execute this strategy. So when do you think ideal times to execute this strategy? Just think about it. The thing is, since you're selling a put, you want to sell puts when the market is down here at a bottom. Look like my thing is not working. But did I click on it? It's not working. Hold on. Let me do something else over here right quick. Oh, what's happening? Nothing's happening. That's what's happening. Well, I'll just go back over here. You want to sell your puts when the market is when it's going up like this and all, ideally. These are indicators that where I was identifying demand in the market at one time. So again, these are areas where I would sell that put, and I will be selling at I like selling right at the money. Sometimes I might sell a little bit out of the money and all, but that's where I would sell at a 30 strike and whatever the price may be at that time. Right now, with the market being up here at a top near a top, and expecting the market to actually continue going up, that can be your belief or your expectation, and you can sell something and expect it to go up. And then the question is, where would you sell at? Would you sell right at the money, or you can sell somewhere out of the money, which is below? In the money is above, So based on your expectation and your strategies and your indicators and all, where would you do that? Ideally, I say always look for bullish signs after a pullback in order to do any selling. It's the way selling of puts and all. And let's take a quick look at the let me see, make sure I got it back. Let's take a quick look at the option chain, and I'll show you some stuff over here right quick. When I was talking about expirations, these are your expirations, like June 27, 25. That's the 27th of June, year 2025, and it's 5 days until last day of trading. That's expiration, and that's how many days you have left of trading that. The example that I was showing you was this one down here, 17th of June, 2027, which is called a leap. When it's a year or more out, they call them leaps. So this is what I was looking at, and there's 725 days of trading left on this, so there's plenty of time there. These are, as you can see, they're calling them weeklies. These right here, you're calling them, these are monthlies. They usually, this is what's been around forever since options been out. They are monthlies, and this is what you see. I'll go out here right quick and show you the numbers that I was looking at. This is where I got that $5. These are, first of all, these are the strikes. Got strikes. These are the different strikes right here. There's 20, 25, 28, 30, 33, 35, 38, 40, 43, 45. The further out, since we were way out of the money, they're not, consecutive strikes. You're going to have, these are like $5 whiff strikes, then $2 whiff strikes, then $2.50 whiff strikes. You're going to have strikes like that, when you're out of the money like this on this particular product. And as you can see, this $5.65 is what, if I click on it, it's going to come up $5.65. Saying that's what I'm selling this for. And if I do a confirm and send on this right now, it tells you, oh, I got 10 contracts. Let me change that to 1 contract. Oh, but even on it doesn't really matter. The number of contracts is always just going to be multiplied by that amount. Is the number of contracts times 100 times that $5.65. So that comes up to $5,000, $5,650. That is my maximum profit when I do this. My maximum loss they show is now they subtract this 565 because that's in my account. The most that I can lose on this now is $39,350 on here. They talk about dividend risk and commissions, and you got to also factor in commissions. But buying power effect when it comes to margin account, this is a margin account that I'm looking at right now. The only margin that it's going to take up is just $8,000. I say just $8,000, but that's a big difference between $39,000 that you would have to actually have in a cash account. But let's go ahead and edit this and go back down to a 1 contract. Like I was showing in the example. Now let's do it so you can see again. Now 1 contract, my maximum profit is $565. My maximum loss is $3,900, $3,935, and all. Now buying power effect again, it's still not $3,000. It's less than $1,000 on this particular trade. So I'm risking buying power effect to make $500. $800 to make $500. That's not a bad trade when you think about it. And then you only looking maybe to make a portion of that, not all of that, So it ends up not being too bad of a trade. So that's that. And the other thing that I want to show, I'm gonna delete that, is these out here are $5 and something. Now, if you go down here to one of these, no trade recommendation, you remember how the strikes were $1, $2.50 apart. Now, when you get to the stuff that's closer to expiration, they actually have more strikes, which are only 50 cents in width. That's what they call the difference between the strikes. They also call it the width between the strikes. It's 50 cents. You got $45.50, $45, $44.40, $44.50, $44, and so on. And as you can see, these options are a lot cheaper. And this is what usually draw people attention because, again, buying one of these options or selling one of these options, you're only going to get $54. You're going to get $54 in less than 5 days, if it works. But I'll go ahead and do one of these. Let me just do it. Let me do it the other way. Click on it and let you see that. And let's go down to 1 contract. One contract. $54. You're going to get $54. And look at this though. You're risking the same amount of money. Well, I think we did a 45 strike. Let me make sure. I did a 45.50. Let me edit it. Let me do a 45 strike. I want to do exactly the same strike. Let's go here. You're going to go here and do a confirm and send. I'm gonna get I did 10 contracts again. Let me edit that. Let me change it back to one contract. But as you can see, with 10 contracts, it's a big difference. I'll confirm and send. I'm only going to get $35. I'm still risking the same. The maximum loss is still more because I'm getting less, and the buying power effect is less. But the return on equity, if you want to start looking at those numbers, what you're going to get based on the amount of money you're risking, is crazy to me. I want to say at all, but that's trades that people do all the time and all, but I don't. But that I'm just kind of letting you see, the money that is everything is time 100 is the big thing here. Is 35 cents turned into $35. That $4,500 turned into $4,400. It's just 35 minus from that 4,500 right there, and that's the maximum loss that you can actually have on that trade. So that's what I want to show there. So that's looking at the different strikes, looking at the money times 100. It's kind of how it works here on the put side. Ideally, again, you want to sell. You want to get where you see the market when it's at these bottoms. At this bottom, at this bottom, at this bottom. You maybe don't realize it a bottom until, like I always say, wait for that confirmation, wait for that confirmation, wait for that confirmation, wait for that confirmation. And if and that's again, ideal put strategies and all. For me, it's a very simple trade and all. But again, you have to wait for bottoms and all. That's the only thing. You have to learn to be disciplined and be very patient about that when you're actually executing the strategy. Right now is not, in my opinion, the time to be selling a put on something like this. Because in this particular case, volatility would have been gone up higher. I'm looking at a weekly chart too. Volatility would have been up pretty high, and you see this volatility probably would have came down a little bit. You were going into earnings, so still volatility might be high since you're a week up before earnings and selling that put, 35 put, all right, the money would have been an idea. Would have been looking back, definitely you can see that it would have been a great trade, and that's ideally how you want to play this strategy. And that's pretty much it, I think. I hope I covered enough to kind of look at the charts, look at the option chain, look at the strikes, look at the money, and give you an idea of one of the strategies when it comes to options, and that's put selling. Have any questions, throw it out there. I'll put some links to some other education stuff that are out there with option, the whole big option place, and some other links that I think are really worthwhile looking at if you're really want to get more into options. And also, you should, on your platform, if you're with a pretty good broker, just like one of these brokers that I'm going to be showing you, you should have education there. And if that's not enough and you still need things to be explained a little bit more and a little bit coaching, contact us here at Right Side Trading or contact me and see if we can help. That's it. But I hope you guys are having a great weekend. Hope you have a great week next week. Make that money, and I'll talk to you later. Have a good one. Bye.